Oil pushing higher today on fears of escalation in the conflict in the Middle East. Crude trading, let's see, WTI up about 2.4%, Brent up about 2.5% there. And with higher oil prices, oil producers have been getting a boost. But on the flip side, we've seen solar stocks, they are plunging as of late, mainly on weakening demand for products despite talk of an energy transition toward renewables. Today, solars are being dragged by Q3 results from solar battery company and Enphase missing on revenue estimates for the quarter and warning its sales slowdown could go into early next year. For more on where we stand in the energy transition, we turn to Pavel Molchanov, Managing Director and Equity Research Analyst at Raymond James, and Neil Dingmann, Truist Managing Director. Neil, I actually want to start with you here because I'm curious, Neil, why I have you. You know, Exxon and Chevron, those results, they both missed quarterly EPS estimates. What did you make of those reports, Neil, and what are your ratings on those two?
I'm a buy on Exxon and a hold on Chevron, and yeah, I thought both were a bit sloppy for the quarter. I was more concerned with Chevron's. You know, their 45 billion Tengiz project had a bit of delay and cost overrun, and you know, it goes back to sort of my thesis. Even with the new deals that both of them announced recently, I think Exxon's assets are more quality assets. I think that's going to continue to show up. And, you know, I think today was another example of just a little bit uncertainty around, you know, the cost of one of Chevron's key assets.
And Pavel, I want to bring you in on the other side of the coin, the renewable energy side of the coin. Enphase Energy kind of exemplifying that with its tumble today following earnings. And I guess big picture, what I'm sort of struggling with here is, okay, big oil had a not great quarter, but still, right, making tidy profits here. Renewables, despite the support from the U.S. government, don't seem to be doing too great. Where are we in this whole energy transition as exemplified by some of these earnings reports?
Energy transition is it's a mega trend measured in decades, and admittedly from quarter to quarter, you know, it's not always going to be you know, as apparent. Look, the solar market, as is true of every infrastructure intensive industry, requires large amounts of external capital. There's no escaping that. When interest rates go up, companies that, for example, build solar power plants need to raise money at higher cost, higher financing costs. And that, all else being equal, slows down the pace of installations. Now, 2023, still a record year for solar installations overall. That includes the United States and you know, globally, but it is certainly not as you know, as aggressive a build out as perhaps we would have expected at the beginning of the year, when the 10-year Treasury was a lot closer to 4% than 5%.
And Neil, I wanted to switch gears. I want to ask you about this report from the IEA, the International Energy Agency. It made some headlines this week. Neil, I don't know if you saw this one. They're saying global demand for fossil fuels likely peaks before the end of the decade, Neil. Coal, oil, natural gas. So that's their forecast. I'm interested when big oil gives a forecast. You know, when Exxon is looking ahead, you know, long-term demand for oil and gas. What do they see, Neil?
They see, I mean, again, the EIA seems like about every, I don't know, other year they seem to extend when that peak demand is going to happen. I've seen that now. I mean, I've done this, you know, 20 odd years, and it seems like I've seen it every other year. So the big oil, I think, basically will come out and say they think it's at least another 10, if not 15 years beyond that. And, you know, I think we've seen this in Europe. I think we've seen it just throughout the world. You know, there might be some calls of that in the near term, but we're just not seeing any signs of that yet.
And Neil, to follow up on that, then, you know, so what does the next year to 2 years look like for big oil?
You know, I think it's going to be a bit more the same, and that is these companies now are turning into, or have turned into, just these huge shareholder return vehicles. And you know, you've seen now Exxon and Chevron, even today, paying back billions of dollars each quarter to investors. So I think that's going to be the key, is the capital discipline is going to stay on one side, and the other, what that's going to translate by keeping that production flat and keeping their spending relatively flat, they're going to continue to have a ton of money to pay back to investors in the form of both dividends and buybacks. And I don't think that's going to change.
So, Pavel, we heard what Neil had to say about buy on Chevron, buy on Exxon, hold on Chevron, excuse me. When you switch it on over to the renewable space again, and the selling that we have seen for much of the year in that group, are there opportunities now that you're seeing?
All the stocks are on sale. That is absolutely true. So both on the interest rate freakout, just the macro multiple compression, that is the number one reason why the stocks are down. Some fundamental effect on the business, although that's more secondary. So you mentioned Enphase, ENPH. This is an S&P 500. One of only 3 solar companies in the S&P 500, by the way. So this stock a year and a half ago was trading at 45 times forward earnings. Today it's trading at 20 times forward earnings. Now, estimates have come down. That is also true. But the bulk of why the stock's down is the compression in the multiple. So from 45, valuation cut in half to 20, that is not price for perfection by any stretch of the imagination. I would look at that one. On the small cap side, I would mention Ameresco, AMRC. This is a company that is involved in all kinds of facets of energy transition. It's involved in efficiency, it's involved in solar, and it's involved in renewable natural gas. The latter two portions of the business depend on external capital, which is why this interest rate freakout, as you can see, has really decimated the stock over the past, 100 days.
So I guess the question is, Pavel, and this is a question that really is across sectors. It's not just renewables, right? We've been hearing from some strategists, we can't start to see really meaningful recovery in certain sectors or even the market overall until we get some stability in rates. Is that true, do you think, of this sector as well?
Yes. I mean, certainly the monetary backdrop and the kind of broader sentiment around cost of capital is one of the variables. I think it's an important one. Keep in mind, however, that's not the only thing that counts. So you touched earlier about the fact that oil and gas companies are making money hand over fist from high oil prices. Well, high oil prices and to some degree natural gas prices are also feeding into electricity rates that are relentlessly going up. This is an important difference between the oil market and the power market. In the power market, prices never go down. They only go up in one direction. So when electricity prices go up, guess what? That makes the economics of solar and wind and bioenergy and efficiency and green hydrogen more economic than it would have been otherwise. So that is a tailwind that we should not lose sight of, regardless of what happens with interest rates.
Guys, really appreciate you laying out the two sides of the energy coin right now and hope to have you back again to continue the conversation. It's not going away. Pavel Molchanov and Neil Dingmann, thank you both. Really appreciate it. Have a good weekend.